Are you worried about Brexit? Don't be. Brexit's impact on the UK has been exaggerated, and the pound is about to begin a recovery that this time next year will see it worth $1.38. That out of consensus view is held by Marvin Barth, head of FX and EM strategy at Barclays. Marvin, why do you think the markets have got this wrong?
I think that they've concentrated strictly on the tail risks and forgotten that there is a whole distribution of potential outcomes associated with Brexit. And it's not that we're suggesting that Brexit is not going to turn out to be a welfare loss to the UK economy. We think it will be. What we're saying is that it's not going to be the extreme worst case scenario. And that really does seem to be what sterling has priced in. So we just think that sterling is mispriced.
It's mispriced to the extent, as your first chart shows, that it's at hugely historical lows.
Yeah, if you go back to 1964, so we're going back about 50 years here, you see that the post-Brexit lows in sterling were among the lowest over that entire 50 years. The only times that you got lower than that were when the UK was having to be bailed out by the IMF in the 1970s or in the middle of the global financial crisis. At current levels, we're right about the nadir of the post-ERM. That seems a bit excessive to us for an event that certainly is going to be a hit to the UK economy, but I think is also likely to be one that we're going to feel over decades, not necessarily in the near term.
Okay, so it should be a great opportunity to buy sterling, but our second chart shows why people have been clearly selling it off, and it's clearly the political risk. But your point here, I think, is that there's greater information coming in about Brexit and about how these negotiations might start and develop, and that is helping to beef up sterling.
Yeah, one of the key drivers of sterling's undervaluation is just the uncertainty that people face this unknown, effectively. We've never been here before. And you could see throughout the back half of last year, we saw increasing amounts of uncertainty going into the Conservative Party conference. Yeah. From there, you started to get information, and you could see there were various points along the way, the Prime Minister's Brexit speech, the approval of the Article 50 authorization, all of those things were taken as bad news, but ultimately they're news.
Yes.
And that reduces uncertainty. This is one of the sort of conundrums I think markets face, is that they have to realize that bad news actually is news and reduces that uncertainty premium.
So viewers might be surprised by that chart. That's the pound against the euro, hence it looks slightly upside. So let's look at the negotiations, Marvin. And your third chart just points to exactly why you think it's very hard to see how the UK is going to be ostracised out of this process because of its importance in the global supply chain.
Well, I think it's important to remember that this is not a bilateral negotiation in reality. Yes, there are going to be two parties seated across the table from each other, the UK and the EU. But behind them are lots of other interested stakeholders, right? And who are those interested stakeholders? There are people who are in the global value supply chain who depend on the UK. That's throughout the entire EU economy.
There's the UK right in the
Right
center.
there in the middle. Roughly in the same area as Germany and Switzerland, in the middle of downstream and upstream production streams. And remember that what the UK does still produce are high-end, sophisticated, high-margin manufacturers. Why do they have high margins? Because they're hard to replicate. This is the best example to me is Airbus, right? Where is EADS going to get the wings for Airbus if they can't get them from the UK?
And your point about the London as a financial centre is the agglomeration of trade, which goes back hundreds of years, which makes it very difficult to see how that could be recreated.
Yeah, one of the things people forget about, everyone thinks that the EU is going to go after financial services here, and it's clear that all the countries there wants some piece of it. But it's really difficult to dislodge an incumbent when you have so many externalities from so many people being here in the City of London, depending on each other and having social networks. Really hard to get that to move. And as you've seen with Finance Minister Schäuble in Germany or the Dutch government's recent white paper on this, the EU is very dependent on London financing, so they can't really kill the goose that lays their own golden eggs.
Final chart is about the possible path in the near term and the long term about how these negotiations could go. Explain this beautiful creature.
You flatter. Thank you. So we started here. There's some sort of distribution for what equilibrium value of sterling should look like. You find out that you're going to have Brexit. Everybody thinks it's going to be the worst case. So they think that the distribution is way down here, and it's at 2 years. Now, the only point that we're making about these points about the negotiations and all that is actually the distribution's much wider. So its expected value is actually higher. But it's also the case that these negotiations are going to take longer than people expect, and the impact is going to be felt over a much longer horizon than the near term. So it's much further out.
People sorry, Marvin. People are fixated with this kind of March 2019 deadline, and they shouldn't be.
Exactly. And so instead of being on this path, we should be on this path, which means if we're basically right here right now, we have a lot of appreciation in sterling left to do. It doesn't mean that the end point is a good point. It just means that it's not as bad as people have thought.
Just finally, Marvin, what is going to disturb all this fairly optimistic outlook? What's the big risk? Is it protectionism globally?
I think there's two key risks here. One is just negotiation failure, which comes from either incompetence, some sort of political event you didn't expect, or the other thing is the UK economy. One of the background risks here is that there is a cyclical risk associated with the rise in inflation and undermining household incomes. If that feeds through, if that continues on that path, then you may see more cyclical reasons for sterling weakness.
We'll hold you to the 138 call this time next year. Marvin Barth of Barclays, thanks very much.
Thank you.